Well, now it's time to really dive into equity valuation. So what we're going to do is, in this first reading, is sort of look at an overview of the equity securities and think about the approaches we could take to valuation. We'll eventually flesh those out and see a little more in-depth examples or, I guess, in-depth analysis, the way we might actually apply it for the exam. So we're getting started here, but we're now moving into valuation and sort of past the background stuff, so you can feel good about that. So when we think about equity securities, so what are the characteristics that we're looking at? Well, the dividends here are going to be variable, and there's no obligation to pay dividends. So when you say, well, what are the mandatory cash payments associated with an equity security? Well, there are none. Remember, an equity security represents ownership in the firm, so if you own a business, you can decide whether or not you're going to take any cash out of that business at the end of the year. Of course, if you own 1/100 of the company, your vote may not be all that powerful, but nonetheless, it's the equity holders who themselves, through the board of directors, that are going to decide what those payments are going to be, and the payments can be zero, and they can be zero for a long time. Now, remember, as we've stated previously or elsewhere, common shareholders have a residual claim to the assets of the firm. What that means is, as long as the assets are worth more than the debt, then the shareholders will choose to pay the debt holders and retain ownership of the firm. And if it works out the other way, that's what bankruptcy is, right? So if the assets of the firm become less than the value of the debt, then the equity holders file bankruptcy, not personally, but as the firm files bankruptcy, and the creditors, the debt holders, essentially become the owners of the firm at that point. So a residual claim, that means after everybody else is paid, you get what's left over as an equity holder. So the common shareholders, of course, are the ones that elect the board of directors. What we're hoping is the board of directors works to protect their interests. At least that's the theory behind it. And there can be different classes of common stock with different voting rights for things like the board of directors or things like acquisition, merger stuff. So we can have more than one class of common stock. But we really don't deal with that in the level 1 curriculum. So realize it exists. Other than that, I don't think you need to worry too much about it. Okay, what about cumulative voting? So this is a provision that it comes through the corporate charter. And what it is, it's a minority shareholder protection mechanism. So if you want to make sure that minority shareholders are protected, there's a number of things you can do. One of them is to allow for cumulative voting. So if we are a minority shareholder in a corporation, what we would really like is enhanced ability to get a seat on the board of directors, maybe not personally, but our candidate to have a seat there, so they could represent our interests. Well, if you're going to a shareholder meeting and there's 3 board positions up for vote, meaning that we're going to elect 3 board members at this meeting, if you own 100 shares and we're doing non-cumulative voting or statutory voting, then you can cast 100 votes for whoever you like for seat number 1, and 100 votes for seat number 2, and 100 votes for seat number 3. 1 share is equal to 1 vote. But if the corporate charter allows cumulative voting, we're voting on 3 seats, you have 100 shares, then you can cast all 300 of your votes toward 1 candidate. So if you have a minority of shareholders who feel like their interests are being trampled, well, then they can get together and say, well, we need to get at least 1 person on the board. So cumulative voting is a minority shareholder protection mechanism. Okay, so when we talk about the equity section of the balance sheet, our minds gravitate almost immediately to common equity or common stock, but we also have this preferred stock thing, which is legally part of the equity section of the balance sheet. And the main distinction of items in the equity section is that there's no mandatory charges. So it's not like debt where you have to make an interest payment. There's no payments that have to be made to equity holders. And preferred stock, also called preference stock or preference shares, is part of the equity structure of the corporation. Now, there's a lot of times in finance where we treat it like debt. Right? So if we're going to calculate free cash flows, we want to know what the flows to the equity holders are. We usually mean the free cash flows to the common equity holders. But nonetheless, preferred stock is something that we want to be able to deal with as well. So it is like common stock in some respects. That is, the dividend payments to preferred stockholders are not a fixed obligation. If a firm doesn't make a dividend payment, it's not like they have to explain that to a bankruptcy judge. And these are infinitely lived assets or infinitely live securities, so there's no maturity associated with preferred stock. But while they're like common stock in some respects, okay, they're also like debt in other respects. So they have a fixed payment, that is a scheduled dividend payment. It's not mandatory. They don't They don't have to make it. If they don't make a payment, then they're not going into bankruptcy court over it. But the way it would normally look is you would have, a par value of, maybe $100. And then you would have some sort of stated dividend rate, which might be, 7%, which would say they are not promising, but they are indicating they're going to make a $7 dividend payment, or the scheduled dividend is $7. That's the fixed dividend associated with preferred stock. Okay, there's usually no voting rights associated with preferred stock, and the preferred stockholders usually do not participate if the firm does really well, right? So if they knock it out of the park and build a better mousetrap, then the preferred shareholders are still going to get their $7 a year, and that's about the size of it. So preferred stock, part of the equity section, but we call this a hybrid security, has elements of equity in terms of how we would view it for valuation purposes, and elements associated with debt. Okay, there's also a couple of other characteristics that can be associated with preferred stock. One of those is that it is cumulative preferred stock. So if the firm is rocking along, so at time 0 or going into time 1, 2, 3, 4, 5, and they've been making their dividend payments, right, to their preferred shareholders, because that's what they really indicated they were going to do. And they did that for a while, but in year 3, they skipped a dividend. In year 4, they skipped a dividend. If you skip a dividend to your preferred shareholders, you cannot pay a dividend to common shareholders. So that's the penalty for skipping the dividend. But in year 5, they decide they want to pay dividends to the common shareholders. Well, now, how much is this dividend going to be? Is it going to be the $7 for that year, or do they have to go back and make up these 2 that they missed? Well, that's what we mean by cumulative preferred. So non-cumulative preferred, the dividend they would have to make here at time 5 would just be the $7. But if it's cumulative preferred, they would have to make up 3, 4, and the current dividend in 5, so they would have to pay 21. So there's generally less risk associated with cumulative preferred, because at some point the firm is going to make up those payments, so there's timing issues, but eventually you're usually going to get it. There's also, we said it's non-participating on the last slide, and that's usually the case, but there is also participating preferred, and that's where you have a preferred dividend that is, it's a $100 par, 7% stated rate, and they additionally have some sort of formula in place where if the firm does really well, based on some identifiable metrics, then there will be some sort of kicker for the preferred shareholders. So instead of getting $7, maybe they'll get $7.25 if the firm does really well, right? So there's some little kicker associated with strong performance on the part of the firm. So there is this idea of participating, although the participation is usually pretty mild. Okay, this is something that when I was going to school, we talked about convertible preferred, but it just didn't happen very often. There wasn't much of it. Today, there's lots of convertible preferred out there. So these are shares of preferred stock, okay, which means that they, receive this or have this stated dividend, okay, but they are also, they have embedded in this a convertibility option. That is, you can give your preferred stock back to the firm in exchange for some predetermined number of common shares. So you can convert from a preferred stockholder to a common stockholder, and the conversion ratio, that's the number of shares. So maybe you give them 1 share of preferred stock and you get a half a share of common stock, or 2 shares of common stock, or whatever the conversion ratio says it is. So, and the notion here is that you can hold the preferred shares and you can get a bigger dividend in the short run. So you get more dividends in the short run. But the preferred shareholders can benefit from the firm growth by converting into common. So if the firm does well, then you convert over. So this is generally viewed as being less risky than common shares, because you have some preference in dividends. There's also some bankruptcy things that would give you some preference, but you have the upside potential of the common stock. And the reason this has become so popular is because this is the way lots of private equity would take their position in a firm, is with convertible preferred. So they get some sort of preference with respect to dividend payments. And then if it's a VC fund, they're going to invest in a small company. The small company does well just before they go public. Well, then you take your preferred stock, convert it into common stock, and then you're part of the IPO and you get to cash out. So anyway, so convertible preferred, something that there's quite a bit of it around these days. This is something that I think is more rare, but for common equity, okay, it can be either common or preferred. and used to be just preferred, but now for either, there is callable and puttable shares. So a callable share of common stock, this gives the firm the right to repurchase the shares at some call price. So that means that if the firm does well, you lose 100%. If the firm does poorly, you lose 100%. But if the firm does well, then the majority shareholders can call those shares back from you at some price. And it may be that you're getting in at $10 and the call price might be $25. So you still don't do terrible, but you're still going to be deprived of some of the upside potential. So since you have good states of the world that are eliminated, callable shares are typically thought to be more risky, right? So you're getting your upside truncated associated with the callability. There's also puttable shares, and this gives the shareholders the right to sell the shares back to the firm at the put price. So if the firm doesn't do well, then you can put your shares back to the company, and this is generally viewed as reducing risk to the shareholders. So callable and puttable shares, again, that applies to both common and preferred shares, although I think it is fairly rare with common shares. I've never had to analyze any directly. All right, so thinking of common stock, preferred stock in our minds, we're probably focused mostly on publicly traded firms, so you can call up your broker, buy a share, sell a share, that type of thing. Well, now let's talk for a minute about private equity. So this is the name is very descriptive. This means we're going to have a group of individuals. They're going to get together and form a club. Actually, they're going to form a partnership, a limited partnership. The limited partners are going to put in some money. There's going to be one general partner, and that general partner is going to go out and invest this private equity into private, that is non-publicly traded firms. So, and this is, in the curriculum, we commonly divide this into two categories, either venture capital, where we're investing in very small, new firms, new ideas, or leveraged buyouts. That's where we're going to maybe take a public company and buy all the stock and take it private. And we'll talk a little bit more about those two subcategories in a bit. But the advantages here compared to public equity are, well, you'd have a lot lower reporting requirements. You don't have to report everything to the SEC and all the stuff that goes with that. The private equity managers are able to focus on the long run. So rather than have to worry about the public's reaction to the next quarterly earnings report, so you're never more than 90 days away from this accountability thing. Then you can focus, 3 or 5 years in the future if you have this private equity orientation, and potentially greater returns for investors because we can align the interest of management and this private equity fund, and hopefully we're going to either start with a small firm and eventually it's going to become Google, and you're going to put in a few $1 million and get out $1 billion when they go public, or you're going to take a firm private and then take it back public, and it's going to lead to big gains. There are some disadvantages, and they're significant. The very low liquidity. Once you put your money into one of these, generally it is going to be, well, the typical life would be 7 to 12 years. So it's going to be hard to get your money out before then. 10 to 12 might be a tighter range on that. So you're going to have the private equity funds are going to have lower ability to raise capital if they need it. Significantly less disclosure, which could be a good thing, but because of the cost associated with it. But if you are a small player here, well, it also means you're not going to have the same access to information to evaluate what's going on with the management team, and there may be weakened corporate governance problems between the general partner, the limited partners, those types of things, right? So the categorization, as I said, venture capital, this is where we're providing financing to early stage companies. So somebody's got an idea, they're working on it, it's going to be great, or at least you and they think it's going to be great, even though it's still in her garage at the moment. Well, you're going to put a few $1 million into this, and that's going to help push this down the line towards, a national rollout or whatever that is. Leveraged buyout, as we said before, the word L, or in this, leveraged. The L stands for leveraged, and that means that we're going to use debt, and a lot of debt. There'll be some equity, but a lot of debt to buy all of the outstanding stock of a firm. So you can look at a publicly traded firm. We're going to buy it all, and then we're going to take that thing private. It's called a going private transaction. So what was once a public firm becomes a private firm, and that allows us to go in and re-engineer and hopefully increase value. And then the end game is to take it back public again once you've resolved the operating problems and those types of things associated with the firm. Related to an LBO, we could also have an MBO. That's a management buyout. Usually it has characteristics of an LBO in the sense that there's lots of debt involved. But in this case, it's the management team that leads the acquisition. And finally, down here, we have the PIPEs. So private investment and public equity. This is where we have public firms that raise equity capital through these private placements. And this provides a mechanism where a public firm can raise equity capital, external capital, at lower costs because they don't have to necessarily hire investment bankers, and there's lower registration requirements and that type of thing because they're dealing with particular classes of investors. So this is a way that if you're going to raise billions and billions of dollars for the first time, that's probably not the route you want to take. But nonetheless, if you just need to raise another few $100 billion, well, this is probably a good avenue, at least in some cases. All right. Okay, so that is, so far we've been talking about equity, both public and private, and you're thinking domestic. Now let's talk about foreign investment, right? So foreign investment, of course, in the CFA curriculum generally refers to non-U.S., I realize that that's not the way the whole world looks at it, and it's not explicitly stated that way in the curriculum either, but it seems like when they go to foreign, they're always talking about something other than the U.S. So if we're talking about investing in foreign equities, well, there's lots of disadvantages to direct investing in some sort of foreign share. And what I mean by that is, if you say, okay, I'm a U.S. investor or UK investor, and I want to invest in Malaysian firms because I think Malaysia is going to do well, and the business environment and technology, whatever it is, right? If you want to go to Malaysia and buy shares, well, that's going to be hard to do unless you're bringing a lot of money with you, and there's going to be a lot of differences in terms of reporting requirements and customs on the exchange and all that type of thing. So if you're a really big player, direct investment is probably makes sense. But if you're not a really big player, then there's other ways to gain exposure to these foreign equities. So the disadvantages of direct investment, okay, well, one, the return's probably going to be denominated in a foreign currency. So if you get your return and it's denominated in Thai baht, well, that's great, except for, you feed your family in euros or you feed your family with US dollars. So you're going to have to deal with the exchange rate risk. Okay? Often, especially if you're thinking emerging markets, these are less liquid investments. Okay? Frequently less transparency, although that's becoming better worldwide. And like I said earlier, the exchange regulations, procedures, clearing issues, those types of things can be very different between whatever you're used to and the country the foreign investment that you want to make. So how do you get around direct investment? Well, one of the most popular ways is with a depository receipt. And what this says is, look, we have these big multinational banks. So what they can do is they can go and buy shares and put them in their vault, and then they can sell claims against those deposited shares. So the bank holds the actual shares, and they sell you a piece of paper that say, you have all the rights to this particular share of stock, right? Even we don't really use stock certificates anymore. I don't know, maybe we do in some places in the world. It is a way for you to gain access without having to actually go to a foreign exchange because the bank's buying big stakes here, and they've got lots of shares. They're going to issue the receipts, and they're going to trade like stock in local currency. Now, the accounting standards and the market procedures are going to be those of the local market, so you still have some of that to deal with. But in its most rudimentary form, the bank buys the stock and then sells you the rights that go with it, right? And it works pretty well. There's a number of classes of these. One, the sponsored depository receipts. This is where the firm whose equity we're buying, so this is some big firm in Malaysia, since we started with that example. Well, the Malaysian firm is involved with the bank in making the decision and facilitating the transaction. After all, the Malaysian firm is probably going to like this because it opens up access to wider capital markets, which is going to be good for them. So the firm is involved with the issuance of these depository receipts, and when that happens, the bank still owns the shares, but the dividends and the voting rights, okay, accrue to the depository receipt holders, right? And if they're an unsponsored, that is, the local firm is not involved, then the bank can ask you how they want you to vote, how you want them to vote, and the bank can pass the dividends on to you. But from the firm's point of view, from an unsponsored depository receipt, the bank is the owner, and it's the bank that's going to vote, and it's the bank that's going to receive the dividends. So a sponsored depository receipt is just one step closer to actually being invested directly without actually having to go and get shares through the local exchange and all that type of thing. So sponsored versus unsponsored. We have global depository receipts. These are depository receipts, just like we've been talking about, that are issued outside the U.S. and outside the firm's home country. Most of these are issued in USD still, they would be issued in the UK. So these are US dollar denominated receipts issued in the UK on this Malaysian firm. That would be a global depository receipt. An American depository receipt, this is really the oldest kind, and that is going to be, again, stock in our Malaysian firm. The receipt is going to be denominated in US dollars, okay? At times, it's going to be traded on U.S. exchanges, not always, but it can actually be traded on the U.S. exchanges and under certain circumstances, and that is an American depository receipt. Now, there's actually a few different kinds of those, but we're not going to get into them at level 1. So an ADR, American Depository Receipt, that's going to be, in terms of volume, I still think that's the largest single type of a depository receipt, and the way that a fairly efficient way to gain access to foreign equities. So global registered shares, this is where you would have shares that trade on different exchanges. So you don't have to trade your stock just in one place. Okay? And a basket of listed depository receipts. Okay, well, you've probably heard of an ETF, electronic exchange traded fund, an exchange traded fund. This is just a portfolio of depository receipts that you can buy. It's like a basket, okay? It's like a mutual fund, but you can trade it on an exchange, and it's a bunch of depository receipts, and you know what's in it, and you decide if that is satisfies your need for global diversification. So more ways to diversify internationally without necessarily making the flight to Malaysia, going to the exchange, hiring a broker, those types of things. All right, what about the return characteristics of equity? So if we're talking about equity returns, then we're going to see that we're going to have dividends, right? So we receive dividend income. Dividends look small to us, but over time has been a very big part of total return. So, as a matter of fact, the reinvestment of dividends has accounted for about 2/3 of investors' compound return on equity securities over the last 50 years, 40 years, something like that. So that dividend that comes in, gets reinvested, and keeps growing has been a big part of equity returns. We can also have capital gains or losses. That is, we buy it for 100 and goes up to 120 or down to 80. There can be share repurchases, which is like a dividend, and we'll get to talk about in more detail elsewhere. But that is where the company is, the firm is buying its own stock, so it is effectively disgorging cash to shareholders. And then there can also be this foreign exchange gain or loss if you're buying equity securities that are not denominated in your home currency. So what we're going to think about most when we think about the valuation of common stock is these first two, dividends and capital gains. And as it turns out, the relationship between these two things is very tight, and I think we're going to be able to show that what we really have to worry about is dividends, or the ability to pay dividends, when we're worried about valuation stuff. Okay, the risk characteristics of equity. So preferred stock is generally viewed as less risky than common stock, which is another way of saying that common stock is the most risky of the securities on the balance sheet. So it's it's lower down the payoff hierarchy in bankruptcy. So if you have the preferred stock, you get a fixed dividend. Preferred stock receives distributions before common stock, and there's different things that would happen in liquidation. So if the firm is liquidated, preferred stock has a better claim, maybe a claim above par value depending on participation rights and those types of things. So preferred stock is less risky than common. Preferred stock is more risky generally than debt, right? So issuing debt, then preferred stock, then common stock in terms of the risk return parameters. So you would expect to see more risk, higher expected return. Equity issuance. So this is, if we're going to issue equity, this is how the fund raises outside or external equity capital. So two sorts of equity. One, you sell some product profitably, you have some net income, and you don't pay it all out as dividends. That's internally generated equity, you retained earnings. Or the external is you go to the equity markets and you sell some shares. So if you decide you need equity capital for whatever it is you're going to do, let's think of it as buying productive assets, then you're going to, you can borrow money, you can retain equity, or you can issue shares in order to bring cash into the firm. This can also issue shares to buy other companies. So effectively you're printing your own currency there. So print up some shares of stock and buy a company. And it also can be used for financing changes. You can issue equity and use the proceeds to pay down debt if you want to change your debt ratio. So equity issuance going to bring cash into the firm for productive assets or to pay off debt, and can also be used to acquire assets directly. Okay, what about book and market value of equity? So we talk a lot about the value of equity or equity valuation. What we're normally talking about when we say valuation and equity is market value. Okay, but there's also a book value of equity, right? So if you think of the balance sheet, okay, so we've got some assets. They're going to be reported at whatever they're reported at. All the historical cost assumptions, all those types of things are going to be embedded in there. Okay, and then we're going to have some liabilities over here. And then at the bottom, we're going to have equity. So the balance sheet equation, assets equal liabilities plus owner's equity. Okay. We can rearrange that to say that owner's equity is equal to assets minus liabilities. All right, so we take this equity, and it's just the book value here. When we're talking about book value, it is the equity stake on the balance sheet. It's assets minus liability, book value of assets minus book value of liability. We can divide that by the number of shares to get a book value per share. We can either have the book value of the entire equity stake, or we can have the book value of equity divided by the number of shares to get book value per share. So book values for equity tend to be poor estimators of market value. So in market value, this is going to reflect the investor's perception about future growth and profitability and all those types of things. So the difference between market and book is that book is based on accounting numbers. Market is going to be based on expectations. Okay, what are those future cash flows going to be? So book value and market value. We estimate market value through our models. We're also going to use book value when we talk about return measures. So we want to talk about ROE and the cost of capital. So ROE, okay, is defined as net income divided by average equity. Okay, but this is book equity. All right? So we do this with book value. So average book equity just means take the equity value from the beginning of the period plus the equity value from the end of the period, and divide it by 2. So ROE, net income over the average book equity, it measures the return management is generating on capital. Now, it is a return on book capital, and there's some reasons that are beyond the scope of this reading that we don't use the market value of equity here. But so we are using the book value of equity, but for better or worse, this is one of the primary ratios or metrics that we use to evaluate a management team. If you can deliver higher ROE than everybody else in your industry, you can bet that the world is going to beat a path to your door. Finally, the cost of equity. The cost of equity, another way to say this would be the required return on equity, right? So, and we sometimes write this like, an R sub E, okay, the required return on equity, and it's what we use, it's the output for the capital asset pricing model or for all the other equity return models that we have. And this is, it's really hard to estimate relative to something like the required return on debt. And the required return on debt isn't particularly easy to estimate, but required return on equity is much harder. But this represents the minimum return that equity holders will accept and still keep their capital employed in this particular activity. So if you can't, it's not to say that every year if we calculate, and we know because God tells us the required return on equity is equal to 12%. Okay, well, if one year we fall down to 7% or minus 4%, that doesn't mean everyone pulls out their equity. But over time, if you're a manager who can't provide the required return on equity, then you're going to be replaced as manager, or your firm's going to dry up and go away because people are going to take their marbles and go play somewhere else. So the cost of equity, this is the required return on equity given the risk of the equity capital committed in that enterprise. Okay, so that brings us to the end of this first reading. Again, some good basic stuff on how we think about risk and categorize risk between the different financing elements. And so this is going to be really basic, but very much required information as we approach maybe a more numerical or number crunching environment for actually calculating the value of an equity security.